lending innovations and the ongoing growth of the secondary market have expanded mortgage credit and the benefits of home ownership to many households perceived to have high credit risk. However, in the past few years, a weakening of underwriting standards, together with broader economic factors such as the deceleration in house prices, has contributed.
Suspend for a second, Mr. Bernanke. There is a vote. Well, I think we can have you complete your testimony. The first vote, we have time. We will then break and come back. I apologize. We have no option. So if everybody will shut off the pages, the chairman can complete his testimony. We will break, vote, and come back. Please go ahead.
Thank you. During the past 2 years, serious delinquencies among subprime ARMs have risen sharply, reaching nearly 15% in July. This deterioration contrasts sharply with loans in the prime mortgage sector, of which less than 1% are seriously delinquent. Higher delinquencies have begun to show through to foreclosures. About 320,000 foreclosures were initiated in each of the first 2 quarters of this year, just more than half of them on subprime mortgages, up from an average of about 225,000 during the past 6 years. As many borrowers of recent vintage subprime ARMs still face their first interest rate resets, delinquencies and foreclosures are likely to rise further. In response to these developments, the market for subprime mortgages has adjusted sharply, and originators now are employing tighter underwriting standards. But that still leaves many borrowers in distress. To help them, the Federal Reserve, together with the other federal supervisory agencies, has encouraged lenders and loan servicers to identify and contact borrowers who, with counseling and possible loan modifications, may be able to avoid entering delinquency or foreclosure. The community affairs offices in each of the 12 Federal Reserve banks have also provided significant leadership and technical assistance to foreclosure prevention efforts. For instance, a public-private collaboration initiated in part by the Federal Reserve Bank of Chicago produced the Home Ownership Preservation Initiative in 2003. Since then, the program has counseled more than 4,000 people, prevented 1,300 foreclosures, and reclaimed 300 buildings. Beyond the actions underway at the regulatory agencies, I am aware that the Congress is considering statutory changes to alleviate foreclosures, possibly including modernizing the programs administered by the Federal Housing Administration, as Secretary Jackson has just described. Prospectively, the Federal Reserve is actively working to prevent these problems from recurring while still preserving responsible subprime lending. In coordination with other federal supervisory agencies, we issued guidance on underwriting and consumer protection standards for non-traditional mortgages last year and for subprime ARMs earlier this year. To help potential borrowers make more informed choices, the Board is engaged in a review of the Truth in Lending rules to provide mortgage lending disclosures. We are considering proposed changes to rules to address potentially deceptive mortgage loan advertisements and to require lenders to provide mortgage disclosures more quickly. We are also planning to use our rulemaking authority under the Home Ownership and Equity Protection Act to propose additional consumer protections later this year. We are looking closely at some lending practices, including prepayment penalties, escrow accounts for taxes and insurance, stated income and low documentation lending, and the evaluation of a borrower's ability to repay. Additionally, more uniform enforcement of the fragmented market structure of brokers and lenders is essential. With other federal and state agencies, we have launched a program to expand and improve consumer protection reviews at non-depository institutions with significant subprime mortgage operations. This project should also lay the groundwork for various additional forms of interagency cooperation to help ensure more effective and consistent supervision. In recent weeks, as committee members are well aware, disruptions in financial markets have increased uncertainty surrounding the economic outlook. In August, the Federal Reserve took several steps to address unusual strains in the money markets and to improve the availability of backstop term financing for banks through the discount window. To help forestall some of the adverse effects on the broader economy that might arise from the disruptions in the financial markets and to promote moderate growth over time, the Federal Open Market Committee this week lowered its target for the federal funds rate by 50 basis points. Thank you, and I look forward to addressing your questions.
Thank you.